Hi, friends. This is Deepika of Neetu. I am a licensed realtor in Maryland and a licensed loan officer in Maryland and Virginia. I am back with my next video. In this video, I'll be explaining home buying process in 7 easy steps. What is the first thing we do when we think about buying a home? We start dreaming about it. How should the kitchen look like? How should the bathrooms look like? How do we furnish our home? Dreaming about our home is such a special thing, but along with it, we should prepare for it as well. So, our first step is preparation. Based on our life situation, our financial situation, are we ready to buy a home or will we be ready in the next 6 months to 1 year? If so, how to prepare for it? I have further divided this into 4 steps. Step A, steady income. We should have at least 2 years of steady income. If we are on W 2, that is great. If we are self employed or commission based employee, we might need additional reserves. Step B, credit score or FICO score. Now, in all credit card websites and your bank websites, you will be able to get your FICO score. This score has to be more than 780 to get a good interest rate. How do we improve our credit score? By making our payments in time, no missed payments, by keeping our credit utilization to less than 30%, by not closing any old credit or opening new credit. Step C, DTI or debt to income ratio. This is a percentage of debt when compared to our income. In this example, suppose we make 120K annually, then we can get our gross monthly income by dividing it by 12. In this case, it's 10,000. Our debt payments could include credit card payment, in this example, 200, car payment, in this example, 500, student loan, if we have any, this example, 600. Along with these debts, what is our the monthly mortgage payment of the future home? In this example, 2,500. If we add all this debt and divide it by our gross monthly income, we get the DTI. In this example, it is 38%. We should have our debt to income ratio to less than 40% to get a good interest rate. Step D, assets. That is, how much money do we have in our bank? During closing a home, we will incur two kinds of costs. One is down payment, the other is closing cost. Down payment is what is our contribution towards the home. Um, it should be 20% of or more to avoid what is called a PMI or private mortgage insurance. What is this? If you make a down payment of less than 20%, the bank or lender sees it as a risk and yeah, they will ask you to pay additional insurance. Closing costs. When you use a bank or a lender to finance your home, they would have to do an appraisal, which would involve a fees. They would have their own processing fees, title costs to transfer title from seller to your name, um, recording fees. There will be some um, things that you have to pay in advance, which are called prepaids, and some that you have to keep as reserves, which is called escrow. The closing cost will range anywhere between 3 and 5% of the purchase price. So, following all these 4 steps, you think you're ready to buy a home. So, the next step is pre approval process. This is when you would reach out to your loan officer. Um, uh, he or she would collect information from you, including the bank statements, your pay stubs, W 2, tax returns. Along with it, they would run your credit to see what is the maximum value of the home you could comfortably afford. They would give a certificate after this process, which is called a pre approval letter. Now, if you have the pre approval letter, what is the next step? Home search. This is when you would reach out to your realtor and give the pre approval letter. Along with it, you would give your criteria um, uh, and the things that you're looking for in a home. This could include the zip codes you're looking to buy a home in, um, the minimum number of bedrooms, bathrooms, the minimum year built, the minimum square footage you're looking for. Um, and the realtor would have access to a database called MLS, where they would be able to see the active homes in the market and also the upcoming homes. They will set up a automated email notification, um, uh, and you could start getting them in the email on a daily basis, and you could start looking at homes. You've been looking at homes, and there's one home that you all really like. Wife loves the kitchen, kids love the backyard, and husband loves the man cave basement. Now, what's the next step? This is when you let your realtor know that you're interested to make an offer on this house. The realtor will then do something called comparative market analysis by looking at the homes that are sold in the past 3 months, comparing it to the subject property, and see if the list price is good, or can you go lower on the offer price. You and your realtor will make discuss and arrive at an offer price, and along with the offer, you will have to pay something called earnest money deposit, which is about 1.5% to 2% of the purchase price. This is similar to what we call as token advance in India. This is just to let the seller know that you're serious about buying their home. When you make an offer, there could be three outcomes. One, the seller could accept your offer. Second, if the offer was low, the seller could do a counter offer. And third, if they've received a better offer, they could also reject your offer. Let's assume your offer was accepted. What is the next step? It's appraisal and inspection. During this step, a certified professional called an appraiser would visit the subject property and do an analysis and to determine what is the correct market value of the property. If the appraisal value comes above the purchase price, uh, great, you got a great deal. But if the appraisal value comes below the purchase price, you would have to bear the difference. The bank would give a loan on the purchase price or the appraisal value, whichever is lower. Then, inspection. A certified professional again visits the subject property, um, looks around and makes an analysis on what are, if there are any minor or major defects in the property. And at the end of this, they would give you a report. This step is very important because if the appraisal value comes below the offer price, or if there are any defects, major defects in the house, it could be about the roof, there is mold in the house, or any other major defects, you could go back and renegotiate with the seller to either bring down the purchase price, ask them to fix the defects, or ask them to contribute towards closing cost, which is called the seller credit. What is the next step? This is when you would go back to your loan officer, talk to them that you are in a contract now, and this is when the underwriting happens. If there are any additional documentation that the bank or the lender requires from you, this is when they collect it. And they would go through all the documentation in detail to qualify you for the loan. During this process, they would issue what is called a loan estimate. This would include the cash that you will have to bring to the closing. This, again, as I said, this would include the down payment and the closing cost. Uh, and the next step and the final step is closing. 3 days before closing, you would receive what is called a closing disclosure. Um, this is similar to the loan estimate, but the final numbers. Um, and once you receive this, you will be asked to wire this amount to the title. And then now it's the closing day. The seller would sign, you would sign, you would receive the keys to your new home. Congratulations, the dream home is yours. um, I hope this video has been helpful. I've completed all the 7 steps. If you have any questions, please leave them in the comment box, and I will definitely get back to you. If you think this video has been helpful, please like and subscribe. And also let me know in the comment section if you would like to see videos on any other topics. Um, until the next video, keep smiling. I'll see you in my next video. Bye.